Welcome to Chronicles of a Dad. In this video, I want to talk about my plan to reach financial independence at 50. I'm not planning to stop working at 50. For me, FI is about having more choice, choosing how I work, when I work, and spending more time with people who matter to me. My rough target is to hit FI around 2034 at age 50 with about $1.7 million invested. I'll walk through the strategy I'm using to bridge from age 50 to when Social Security starts. At age 50, my target is a $1.7 million portfolio in nominal dollars. To think about lifestyle, I convert everything into real terms, in this case, 2034 purchasing power, assuming about 2.5% inflation per year. In the base case, the plan supports around $98,000 per year of household spending in 2034 dollars. For context, that 98K in 2034 is roughly equal to about 80K in 26 dollars after adjusting for 8 years of 2.5% inflation. So the core question is, can that portfolio with that spending level reasonably last for 40 plus years? Here are the core assumptions behind the plan. I start in 2034 at age 50 with a $1.7 million portfolio, and I assume 2.5% inflation going forward. On top of the portfolio, I include a small pension-like income, around $11,400 per year starting at 50. Later, there's Social Security for both me and my spouse. Together, I estimate about $42,000 per year in real terms, split roughly $22,000 for me and $20,000 for my spouse, modeled to start at age 62. That start age is flexible and could move depending on how the portfolio actually performs. For investment returns, I mainly test two scenarios, a 4% real base case and a 2% real risk case. For the asset mix, I'm currently modeling a simple 80-20 portfolio. 80% in an S&P 500 index fund as the main growth engine and 20% in gold via something like IAU as a volatility buffer. Rough back tests of an 80% US stocks / 20% gold portfolio over about the last 30 years with quarterly rebalancing show an annualized real return around 6.5%, with a maximum drawdown of roughly minus 42% during major crashes. That's somewhat shallower than the worst drawdowns for pure S&P 500 exposure, which have historically gone beyond minus 50%. For this plan, I'm deliberately using more conservative assumptions, a 4% real base case and a 2% real risk case. So I'm planning off numbers that are lower than the historical averages. The 80-20 split is not fixed. If I find a simple allocation with better average return and smaller drawdowns that's still easy to maintain, I'm fine changing it later. The key is to stay within that 2 to 4% real expectation band. This is the decade-by-decade view in both the base and risk scenarios. At 50, I start with $1.7 million and about $98,000 of real household spending. By 60, after a decade of withdrawing around 5.1%, the real balance in the base case is about 1.52 million, and household spending dips to about 89,000. In the risk case, I'm planning around a floor of roughly $75,000 real. By 70, 80, and 90, in the base case, the real portfolio balance stabilizes around 1.49 million, while real household spending levels off at about $113,000 per year. The nominal numbers climb into the 300,000 plus range by age 90, but that's just inflation on the same real lifestyle. This table is also conservative in another way. My spouse and or I may still be working after 50, even part-time. Any earned income would likely improve these numbers further. This projection assumes we're relying primarily on the portfolio, plus the pension and Social Security. So that's the current version of my Bridge to Social Security plan. Hit FI at 50 with around $1.7 million, use a higher variable withdrawal rate before Social Security, drop the rate once Social Security starts, and stay within a 2 to 4% real return expectation band. Over time, I'll come back to this, compare it with what actually happens, and update the assumptions, whether that's the allocation, the spending level, or the timing of Social Security and work. For now, this gives me a clear framework for what financial independence at 50 with $1.7 million actually looks like in numbers.